Welcome to Bar Chart's series of webinars designed to educate you on a variety of market concepts, inform you of the features and tools Bar Chart provides related to these concepts, and finally offer traders insight to help you make a more informed investing decision. Today's subject, volatility trading, strategies, and tips. Now, our discussion today is going to revolve around the VIX. And if you're not familiar with this instrument, the Volatility Index, which some people will refer to as the Fear Index. Oops, excuse me. And we're going to go into a little bit more of a discussion what the VIX is in today's session. But what's more important is how can we use the VIX as an indicator to give us clues about market sentiment and permission to look for and execute certain types of options strategies. So hello everyone, my name is John Rowland, Bar Chart's Head of Trading Education, and as I alluded in the introduction, the VIX is a dynamic tool that can give traders a lot of information about markets and market conditions, namely the S&P index, and armed with this information can help stack probability and timing in the trader's side. But before we get to that, please welcome my partner and our moderator, Bar Chart's Project Director, Jean Baker. Hello, Jean.
Good afternoon, John. How are you doing out there?
Dodging the raindrops today. How you doing out there?
Yeah, dodging the raindrops too. Before the meeting started, I was saying I've heard a rumor that we might be getting snow here soon, but can't believe everything you hear. Yeah, I can't believe that. Anyway, doing
Want to
good.
build a snowman?
No.
All right, you ready to get started?
Yes. Why don't you go ahead and get started, John?
All right, thanks, Jean. All right, just a reminder that today's session is for educational purposes only, and that risks to buy, sell, hold, or trade securities, commodities, or any other investment involves risk and best made on the advice of a qualified financial professional. Options trading is not for everyone, and options trading can result in a loss of your principal, and even more if you don't understand the risks involved. And under no circumstances shall we be liable for any loss or damages that you or anyone incurs as a result of any trading or investment activity that you or anyone else engages in based on information or material that you receive through barchart.com and our services. Okay. So what is the VIX, right? What does it represent? So here's some kind of just basics about the VIX and why it can be a valuable tool to us. So the ideal or the understanding that the VIX has this inherent inverse relationship to the S&P because of markets participants' use of options and that relationship to market sentiment. So here's the VIX and a chart of the VIX over, let's say, the last 6 months. So what I'm going to do is I'm just going to add the S&P index to it. And it's going to be this blue line. And so what you can see here is, notice how as the VIX falls, the black line, the S&P rises. And as the VIX rises, the S&P falls. So this inverse relationship happens because traders become fearful of a declining equity prices, and then they purchase protection using put options. This in turn drives option prices higher, and thereby increasing the implied volatility and the VIX. So in essence, the VIX becomes a proxy for market sentiment. Rising VIX, bearishness; falling VIX, bullishness. And, so over the years, This inverse correlation has led to a trader's adage, an old floor saying. And that saying is that when the VIX is high, it's time to buy. And when the VIX is low, look out below. So herein lies the gateway to our market information and also our strategy selection, right? This kind of concept of how the VIX and this market sentiment. So everything is relative, and we need to understand what is high and understand what is low. So what I want you to do is, or be aware of, is one of the things we can use to help us with our discovery of what is relatively high or relatively low, in essence with the VIX, is we're going to look at something called the put-call ratio of our individual equities. And that will also give us a clue into this kind of market sentiment. All right. So some simple math behind the VIX. Now, I don't want to overcomplicate how the VIX is derived. It's very, very complicated formula, but rather, what does it represent and how can we use it as a tool? So first of all, it's a measurement of the expected 30-day implied volatility as priced through the S&P 500 options market. Now, implied volatility is a projection of the annualized standard deviation movement of an underlying, in this case, with the VIX, the S&P, over the life of the option. So the greater the implied volatility, the greater the expected move. Now, one standard deviation implies 68.2% chance that the price movement will occur over the next 30 days. So the VIX through IV can project where price might be or might move in those 30 days based on the market's trader perception through the pricing of options. Now, I know this is a mouthful, but here's what you need to understand and what you should take away from this. We could convert the VIX into a percentage price movement. And how do we do that? Well, there's two formulas that we can use. First of all, we can just take the VIX and divide it by the square root of 12 months in a year. Now that value, 12, square root of 12, is 3.46. So in the case where the VIX is at 20%, and I divide it by 3.46, this is now implying that there's a 5.78% movement in the S&P over the next 30 days. If I want to do a one-day percentage movement expressed by the VIX, well, that equals the VIX divided by the square root of 252, which is the number of trading days in a year. And so the square root of 252 is 15.87. So here's an old trader's trick. It's called the 16 rule, and that's why we have the 16 in the parentheses here. 16 is pretty close to 15.87, and it's certainly in a statistical aspect. What is it, 1% or so, or less? So what traders do was they just say 16, and they take the VIX and divide it by 16 to get an implied one-day movement. So for instance, in the example here, if the VIX is 32, then 32 divided by 16 would imply a one-day movement of 2%. Now, how are we going to use this information to our advantage, right? So we're going to use this as a measuring stick of where we're going to start setting our options strategies, either to give us exposure or where we need to be if we want to take on less risk. And again, based on the type of option strategy that we're going to take on, how long we're going to hold that strategy for, I can use either that 30-day or that 1 day. Now, for some of my short-term options traders, I know I have a lot of you out there, especially those credit spread type traders, using the 1 day percentage. There's a lot of these traders who do credit type spread option trades where they might put a trade on Monday and they take it off on Wednesday, or they put a trade on Wednesday and they take it off just before Friday's expiration. So this kind of gives you an idea of where the market is pricing in volatility, where you can anticipate where you might find some greater premiums, but also to help you define your risks, where you can look to either buy your protection or know when you're wrong, when price moves beyond those ranges. So the option strategies that we're going to employ when the VIX is high, right? When the VIX is high, it's time to buy. So I'm not going to just jump into the market because the VIX is high or it's rising, or if it's reached an elevated level. So what I'm going to do here is I'm going to use some kind of just simple rules and also kind of look at this in terms of, relative to where we've been. So notice I've drawn two red lines here. One is at 32 and one is at 20. And so you can see over the last year or so, that's kind of been the range that the VIX has been in. On the low end, around 20, on the high end, 32. But I do want to point out that in other market conditions, down here, this was a very bullish market condition. You can see the VIX has a different range. And the last time we had kind of bearish conditions during the beginning of the COVID, you can see that our VIX was a lot more elevated. So it's all relevant to the time and the market. But we can see that since the beginning of the year, there is a really good correlation between when the VIX is high and it's time to buy, and when the VIX is low, look out below. Okay? So what we're going to do is we're going to wait. Here's the kind of rules we're going to look for. We're going to wait for, in the conditions of the VIX is high, we're going to wait for the VIX to get above 32. Now, I like to see a high after a time of rising VIX. In other words, let's say a new high within the last 10 days or the last 20-day period. And then I'm going to wait for a day when the VIX opens higher and then finishes lower on the same day. Now, it might come in the form of, if you're familiar with candlesticks, here is an engulfing candle. Right? So those kind of candlestick pictures. But it just has to open higher and then close lower. That's all we're really kind of looking for. And then finally, we're going to look for a confirmation. And that confirmation is when the VIX crosses back below 32. And that's going to be our green light, our permission to move forward with this strategy. Now, notice here we see that the VIX was rising and it was making higher highs, and it definitely was above 32 and relative. And if we counted the last 10 days or the last 20 days, this was the highest value. And then you can see where the VIX opened higher and then closed lower. Now we're getting those signals that we want to see. And the next 2-3 days, the VIX closed below 32. That would be that confirmation. And you can see that from the point when the VIX made the high and then closed back below 32, that's where that bottom was created. And we got that little bit of a rally. I think this was back in the last week of September to the first week of October. But then the VIX since then, you can see, has gotten back above. Now, what's going on today? Well, has the VIX make a new high compared to like the last 10 days or the last 20 days? No, it hasn't. So, we need to wait for a higher VIX to really give us that condition, that market condition, that bearish sentiment, right? Or what we want to see is one day where the VIX opens up higher and closes lower, which we kind of saw here, but we didn't get the VIX back below 32. So the conditions are getting right, but they're not there yet. Not there just yet. All right. Now, in the opposite, when the VIX is low, we're just going to do the opposite. We're going to wait for the VIX to penetrate below 20, and then we're going to look for one of those outside or reversal days, and then a close above 20, and that will be that green light confirmation, right? So we've got to have a little more patience, especially on the low end side. The VIX will kind of hang around the low VIX for a while, where on the upside it kind of just whips back and forth. So let's do this. So now that we have our green light, what is going to be our plan of attack? Well, what we're going to do is we're going to sort through those sectors that have a strong relative strength. In other words, have been outperforming the S&P itself and or other sectors. And we're going to identify those equities whose implied volatility have become elevated. We're going to use filters of implied volatility rank and implied volatility percentiles. And rank is going to be probably the more important of the two, but they're both definitely valuable pieces of information. Now, what am I saying here? The VIX is telling us that the market conditions are right for a potential relief rally, either the beginning of a new bull market or just prices are going to go up. And because of this high bearish sentiment, we're going to look for that high IV, high implied volatility, in a select group of stocks that have been outperforming, and that high implied volatility is going to be telling us that the premium prices of options are very expensive. So we're going to choose credit type strategies. We're going to try to capture these rich premiums. And these strategies will be successful if volatility falls and the underlying stock's price rises. Now, these two scenarios are mutually exclusive, but if they both happen, then the strategy most likely is going to be very successful. So what are these strategies? We have selling naked puts, bull put spreads, and short strangles. So let's talk about each one of these just briefly. So naked puts is kind of a strategy where I'm going to sell a put. What really I'm trying to do is buy into a security at a discount. Now, what I'm going to do is I'm going to look at a strike price that I believe is the value of the stock that I will want to buy. And if my put that I sold gets exercised, I'm okay with being long or owning that stock at that strike price. But I'm going to get in at a discount because I'm going to collect that premium. But also a naked put strategy works in a market environment that we're seeing right now, because maybe I don't want to invest in taking a new long position, but I am anticipating, these bear market rallies or these relief rallies. So this is a way of me to generate income while I'm waiting for the market to start showing me bullish tendencies. The bull put spread, we're going to go into detail. That's what we're going to focus on today. But there are a couple factors that I want you to kind of be aware of, like that this spread has a high chance of being exercised, especially if we set our strike too close to current price. But that process that I just showed you before, where we're going to look at the percentage price movement, will help us locate better strike placement, so that maybe we don't need to worry about that so much. And then short strangles, well, this is more of an advanced type trade. A lot of traders use this to kind of leg into another trades. But again, if we select the right strikes and we get a fall in implied volatility, then this would be definitely a strategy that would work, even if the market does move. Okay. Just checking my notes, make sure I got everything I want to do. All right, so let's do this. All right, so what did we say? We said, okay, we're going to go and first look for those stocks that are outperforming. So there's a couple ways we can do that. We can come under our stock page, and what I've done is I've gone to the stock market sectors, and we have, we can sort this by today's price action, last 5 days, the last month or so. And then again, I think because we're doing a credit spread, we're probably going to be setting these credit spreads out for a limited amount of time, maybe 5 days a week, maybe 20 days, maybe as much as 40 days. So I'm kind of going to look and see which sectors have been outperforming, maybe like in the last month. Now, this is a kind of a testament to what we're dealing with right now in the market is, in the last month, of all the sectors that we have out there, none of them are performing very well. But in a relative sense, the energy market is only down 1.2% this last month, while the S&P is down 12%. So the other kind of way we can go through here is we can look at, market performance. And this is a nice little chart too. And you can see that, energy has definitely been one of the most favorable or outperforming sectors through, let's see, from about July, where all the other 10 sectors in the S&P are down. But, again, everything's relative. You can see that there is a cluster of some of the sectors that have kind of, hanging in there right around zero. And that would be consumer staples, materials, and I think that is industrials in there. So you could look in that those sectors as well. But let's just use energy, because that one is the one that's been outperforming for most of the last 6 months or so. So I'm going to go to the energy sector, and here are the stocks that are in the energy sector. And I'm going to go to our screener. I'm going to start screening on those criteria that I just mentioned to you for our strategy. What is our implied volatility? So I'm going to go to options view. I'm going to add rank. Now, because I want to see a high rank, let's pick a high value. Now, again, every trader is different. I'm just looking in that top quadrant, right? Top 25%. So I want to see my rank above 75. IV percentile. Now, this one, I'm not going to put a value in here because I'm going to use this more as a perspective or a comparison analysis. But again, if you wanted to put in, let's say, 50% or 75%, that would be fine. I'm going to come down and add the put call open interest ratio. Now, again, every trader is a little bit different. I'm going to set the bar high here. I'm going to say, let's make sure that I have a high open interest put call ratio. But if you're somebody who's into looking at the put call ratio from the volume aspect, that's fine as well. All right. And then finally, I'm going to add something called beta. And if you're not familiar with the term beta, this is basically looking at the price movement of, or the volatility of our individual stock as it relates to the S&P. And we're going to use this as kind of a multiplier. We're going to add this to that percentage movement that the VIX is implying to kind of give us that range of price so we can anticipate for our individual stocks. So now let's check our results, and you can see that of the S&P energy sector, these, 6 stocks here, qualify or fall into those criteria that we use. Now, the only filtering criteria we really kind of using here is implied volatility rank. So I can go in here and I could look at, where I am on my ranking, categorize them that way, or implied volatility. Again, looking at open interest and volume. And then I have that beta, that multiplier that I'm going to use. So just looking at this, eyeballing this right now, I can see that, Halliburton comes to the top of, these lists. And first of all, it has the highest implied volatility rank. Has one of the highest implied volatilities percentiles. The put call ratio is, right around that 1. That's kind of where we want to see when we see a lot of sentiment. Again, I could pick one of these other ones. And what is kind of interesting to me is, the put call ratio for the volume for today. Now, when I came on this morning, this was actually below 0.5, which was kind of indicating to me that there might be some buying in this stock today, even though the implied volatility is higher. And then you can see our beta here is 2.08, which in other words is saying is that for every dollar move in the S&P, Halliburton will move $2, or 2 times whatever the S&P moves. Okay, so from here, now we have a couple of different ways we can do our process. So one of the easiest ways I think to do this is just go to Halliburton. And before I go to the options page, I'm going to just do a little chart analysis. Now remember, our beta is 2.8, and let's go back to our VIX. Our VIX is 33.64. So let's look at, let's say, an options trade that is about, 2 weeks out or maybe a month out. So we're going to look at that 30-day. So we'll do 33.64 divided by that 3.46. And then we're going to times that by our beta, 2.0, I think it was 08. And what this is, the VIX is kind of implying to us is that Halliburton has a 68% probability that it's going to move around 20% over the next 30 days or so. So let's go back to Halliburton, and I'm going to a chart. And so what I did is I took the liberty of doing the math. And then when I came out this morning, when I was, we can see we're right around $30. And remember I said that the put call ratio on volume was kind of hinting that there was buyers today. And you can see that, it opened, it traded lower and it's now back up. So that kind of is confirming that. But a 20% move from 30 would be $6, right? So I put 36 up here and I put 24 down there. So now what I've done is kind of defined this range that I know that the market is kind of implying that price can move, and that I want to kind of look for strikes that are in this range to gain that greater premium, but also is kind of telling me, where's my risk in terms of the downside. Certainly a risk, around $24. And which is kind of interesting is once I did that risk analysis based on this percentage movement, it also lines up with structure on my chart. So that gives me a little bit more confidence that no matter what strike I choose, let's say between 30 and 24, that I know that my risk here is, in terms of price movement, is below 24. So that would be where I would probably want to set the other side of my bull put strategy. So from here now, I can go into our option strategies, and we're going to look at a credit or debit spread. So we'll just click on both of those. And we said our strategy we're going to look at is the bull put strategy. And this is for Halliburton. Now, again, where am I going to pick those strikes? Well, we did say that the lower strike would probably be, around 25, now, 24. Notice that none of these are there. That's not a big deal. Sometimes if you just come back in your screener here and change, notice that it's only with screening on very short-term options in terms of expirations. So let's widen this out a little bit. Sometimes that helps. So I'm going to go out to November. That's 2 monthlies out. That's about 35 days out. And let's see what our result is then. And let's see if we get some 24s. Yeah, there's one. Here's a 29.24. Here's a 27.24. And that would be, the strategy that we would employ. Now, again, that's the low end. The 24 is the low end, that risk. Now, how can I define where I'm going to look for that first leg in? So again, this could be part of that process of looking at Halliburton from a technical aspect. And, I could do something just simple like, maybe I'll just add a moving average. And maybe a moving average, let's say a shorter term one, let's say a 10-day moving average. And that comes in around 28, right? So I'm kind of saying, hey, this is trending higher. Where do I think that it's going to hold value? 28. And I know my risk is I'm wrong if price goes below 24. Bollinger Bands are a great way to kind of define, a range of price movement. And you can see the mean for the Bollinger Bands is 27, right? A little bit above 27. So those would be two strikes that I would be interested in because they're closer to current price. I know the premiums are going to be a little bit richer, but also where I'm going to set that outer leg around 24. Again, if I went back to my Halliburton trade, I think if we look at the 28.24, here's a 27.24, right? Between now and November 18th, it looks like we could recoup about a 24% return on this particular trade. Now, the other way that we can kind of walk through this process is I can go back to options, and here we have the bull put credit spread. So this is going to be a screener that's already pre-designed for us. And what I've done is I've opened up the set filters on this screener, and you can see I have a lot of variables that I can change, but the one that we need to bring in first is we know the name of the stock that we're going to look at. In this case, it's Halliburton. So I'm just going to type in the word symbol, and I'm going to add that to my screener and just write HAL. Now, the other thing that I might have to do an adjustment here is sometimes in some of these less liquid options markets, Halliburton is a big cap company, but it doesn't trade a lot of options. Now, if you're trading like an Apple or an Amazon, you're not going to have to worry about this. But one of the things you might want to do just to give you some more candidates to look at is I'm just going to lower the threshold for the volume and the open interest for my two legs. And the other thing we can do is something called a moneyness. And what did we decide? Well, we did that percentage movement for Halliburton. We said that there's a 60 to 8.2% that the Halliburton could move 20%, either direction. We're doing a put spread, so we probably want to be closer to current price or below. So what I can do is change that to 20 and see what happens. And then what really happens is we get a nice selection of strikes that are in that range that we're kind of looking for. And the screener now is using some of those other criteria that were pre-designed for the bull put credit spread. So the one I'm kind of looking at here, I see this 28.25, maybe my reward is not as great as I want, for maybe this type of strategy. But again, there's that analysis that I can do. Now, if you want to be very specific, you can come back into the set filters and just type in the word strike, and you can set the strike values that you actually want. So we could come on here and set that. Or maybe because you're familiar with this particular stock, you might say, hey, I want to just look at a strike differentials that are at $3 or $4 or $5 or something to that effect. You can set that as well. So there's a lot of ways we can really refine the screener process, either through the symbol itself or through the bull put credit spread screener. Now, I will show you something up here. We do have a webinar that goes into how to trade the bull put credit spread screener. And one of the things in that is there are some kind of rules or just guidelines that kind of look for more profitable type trades. And I would recommend, if that's something you're interested in, to do that as well. And again, in that webinar, you're going to find out how to set up a more refined bull put spread screener. There'll be a screenshot in there for you to look at. And again, this would be the criterias. Now, I don't know what's going to happen here, but we know the symbol that we have, Halliburton. I'm going to add that. And let's do this. Remember, we're going to need to increase our volume and our leg. And again, let's go to 20 on the downside for my moneyness. And let's see what we get. All right. So here, what this screener is doing to get a more profitable trade based on the theories that we're going to present in this webinar is we're going to be looking at setting a put strike that is right at current price, a little bit more risky. But again, if we use this concept of VIX, and VIX is high, time to buy, and I use other technical analysis, maybe RSIs or MACD crossovers or whatever that you're looking at, this might give you a lot more confidence to look to take trades where the first leg is a lot closer to current price. And you can see that, our max profit does go up quite substantially compared to some of the ones that we were looking at before. But again, if you're more of a conservative trader, it's that trade-off, right? The closer I'm going to be, the more profit I'm going to make. The farther I set my legs away from current price, the lower my max profit is going to be. Again, it's kind of this give and take between the two of them. All right. So when the VIX is low, look out below. Again, what we're going to do here is we're going to pick from equities that have relative weak sectors, right? We're anticipating the market is going to go down. But because the VIX is low, we're going to look at low IVs, ranks, and percentiles. And this is going to give us an opportunity to look at debit type option strategies, those who are actually putting money out, not taking money in as a credit. And these strategies are the ones that are going to benefit from a rise in volatility, the VIX, and a fall in stock prices. Now, what are some of those strategies? Well, the first one is buying puts. Now, let me just pause here for a second. We'll time out. I am saying in the beginning, this strategy, we're kind of going to pick on the weak sectors to look for opportunities or better opportunities. But this buying put concept on the VIX being low is a strategy that I use in my portfolio. In other words, stocks that I already have in my long-term portfolio, part of my trade plan is I always want to have some type of put protection. Now, if I use about 2%, if I continue to hold a put protection in my portfolio at all times, that's going to take away from the potential of my portfolio. It's going to be a drag on my returns for the year. So I will wait for opportunities. Again, that green light when the VIX is low, that's telling me that puts are cheap, and that's the opportunity where I'm going to look to buy some longer dated puts just to protect myself in case something happens. Bear put spreads, just kind of like our bull put spreads, will again, we're kind of going to pick on those weaker stocks. Long straddles. Now this, is kind of counterintuitive, right? A straddle is we're going to pick one strike and we're going to buy a put and we're going to buy a call. Again, the theory behind here is that the VIX is low, the premiums are cheap or well priced, and we're anticipating a price movement. And so what you can do in this scenario is you want volatility to come in, and you're going to anticipate that volatility is going to come in. So typically what I do on this one is I will buy this long straddle, and let's say the stock that I pick on, the price does fall, right? So volatility starts to rise and the stock is falling. So what I'll do is, I'm buying a put and I'm buying a call. So as the stock starts to fall and the volatility starts to rise, I'm going to get rid of the call leg. I'm going to sell that leg out. Usually you're going to take a very small loss, but sometimes, volatility jumps quickly and you actually can break even on that, depending on how quickly you move. Again, looking at that percentage movement on a daily basis or a 2-day basis, if I reach one of those thresholds, boom, then I'm going to do that. I'm going to roll out of that call. And then what I'll do is I'll wait for that stock now to fall or the implied volatility to rise. Let's say go from 20 to 30, or 32. And then I will sell a put at a lower value and a lower strike. Now, what I typically try to look for is to collect enough premium to pay for the long put that I first got into this trade. And I usually look for like a $5 differential. It depends on the stock. It depends on, how much the stock is worth. But think about it. If I can do that, then I'm long a put and I'm short a put at the same value. And now I've just collected that, locked in that potential profit, limited my profit, but my profit is going to be the width of the spread that I set those two strikes. And I do this a lot. This is a really good trading strategy in terms of how this market currently is. Typically, these bear market rallies, the VIX will fall down, and that's will give me a good opportunity to put one of these trades on. Matter of fact, I think right now I have 2 or 3 of these currently on where, I don't have to worry about what the market is going to do. I know that I have no risks in terms of a dollar value, but my profit could be quite substantial depending if that stock continues to fall, especially in this bear market. So I can go through the process of showing you how to set up a bear put spread, right? Either through our screener or through an individual trade, but the VIX is not low, the VIX is high, right? And again, there's a lot out here, but again, let's say we pick on a certain sector, one of the sectors that has been underperforming, I think, is kind of consumer discretionaries. I can just come in here and actually, let's just do that. I'll just type sector and add that. Consumer discretionaries, and what's going to happen? Well, I did get a couple this morning and I didn't get any. But again, the VIX isn't in the right position, so we can still do that process. I'll add my implied volatilities. If I just look at this, let's add one more filter. Let's go add that implied volatility. Choose information. excuse me. Yeah, let's add that rank. Let's see what we get. I think we're not going to get anything here. Let's see. Oh, we did get a couple things. All right. So, actually, we don't want a high and buy. I'll tell you I did this wrong. We want a low one. We want to be below. Let's do that. Yeah, that's probably what's going to happen. Not greater than, but less than. Yeah, that's what I was afraid of. Not going to get a lot of candidates, right? So it's because the conditions are not right. But at least the methodology, at least they explain the methodology going forward is the same process. Okay, so all right, let's do this, Gene. Let me take a moment here. I see that you sent through a lot of questions, and a lot of them look very long, so I got to get my glasses out to read these.
Okay, so while you're going through those, John, I just want to point out to everybody that a lot of all of the information that John's been presenting to you, the different option screeners, going into the stock screener and pulling in the IV rank, IV percentile filters, those are all part of a Premier subscription. So, while you can use the stock screener as a free member, there are certain filters, including these, options, the IV filters that are Premier only. So if you're not a Premier member, and I mean, this information that John's presenting here today is really a great use of the data that's available on the bar chart website. I encourage you to sign up for a free 30-day trial. There's no obligation. You'll be able to play around with these concepts, run through different screeners, and at the very, very end of the session, John will also show you where our webinar archive is, and a lot of the pages, the slides that he's been presenting are available in PDF format for you to download. So we'll go through that at the very, very end.
Okay, great. Thanks, Gene. I always get confused what is and what is not a Premier feature. So I'm glad you're always in our sessions together to kind of sort that out for us. So I appreciate that. All right, so I get a lot of questions here. I think I'm kind of going through them. I'm reading them all. I think I've read a lot of the, answered a lot of these. So Kevin had kind of asked a general question about, why does the VIX go up, or why do investors scramble to buy downside protection, in times of fear? In other words, that market sentiment. I think it's just the way the market works, right? Fear and greed what drives investment, at least, in terms of flow of capital. So, there's that fear index, the volatility index, as traders buy protection. When the market is moving up, when the market is in a bull, they don't have that fear, right? They don't worry about it. Now, don't forget there's something called the put call parity ratio, or parity, which says that, yeah, hey, they're buying puts, but it also increases the value of the calls as well, because there's this arbitrage could, if the calls weren't going up in value, there's ways they could do like synthetic trades and capture that arbitrage. So it's not just the puts, but it also is the calls. So Kevin, you can also think about opportunities where the VIX starts to rise in a rising market. Now that's a rarity, but it does happen. And that might give you an opportunity, let's say, to sell cover calls on the stocks that are in your portfolio, right? You're going to get a little bit more premium. So I get another question here about, and this is a little bit more complex. This is about looking at, let's say, the outright VIX, which is what I just showed you here, and then looking at what we call the VIX futures. Now, there is a lot of theories about if the VIX futures is more expensive or less expensive than the actual VIX. There are different opportunities, and I'm not going to spend a lot of time on that one. I think that's a really complex kind of subject. But I know that just recently we did get that inverted VIX futures just a few days ago, or at least I think it was beginning of last week, or maybe 2 weeks ago, and you did see a pop out of the market. So it is kind of more, a better timing tool. So if you understand how VIX and VIX options works, yes, definitely. Yes, you can definitely use that. And then let's see, I have a question here from Jim. Looking at the daily chart of the VIX for the past year, sure looks like 34 is top. What are your thoughts? And could we look for the VIX roller? So let's go back to that, because that's a really good question. So yeah, I think, if we want to look at this on a historical basis, Jim, I think you're going to be surprised that 32 is not, 34, yeah, it's at the high end of the range, but there's really more of a theory that you don't really get this capitulation in the market until you get the VIX closer to 40. Now, in the last year or so, we hadn't even gotten close to that. But if you go back in history, you can see that a lot of these big price falls in the S&P, the VIX got much higher, much, much higher. So again, it's all relative, right? I think certainly for what we're seeing in the market right now, yeah, this 32, 34 area is a very elevated level of what we've seen. But on a historical basis, in terms of, market capitulation or timing, what we could quote unquote the bottom, there's a lot of folks that believe that we really need to see the VIX above 40 before you get that scenario. So, but for today, certainly, the VIX is being elevated here, and again, think about that movement that we're predicting here. VIX is at 34, and divided by 3.46. Market is already implying right now that we're going to see a 10% movement in the market in the next 30 days, right? And I think, whichever way it goes, obviously most folks here are thinking that the market is going to break 10% to the downside. Now, 10% to the downside in the S&P, is that a bad thing? Is that a good thing? Is that doomsday? No, I don't think it is. I think it's actually probably a healthier prospect for this market. And this is I'm sorry about my chart here. This is a chart that I've been using for my Friday sessions. We'll talk about that in a second. But, a 10% movement from where we are, 3,600, that's 360 points. That puts us down right around here, this 3,400. Is that so bad? I don't think it's so bad. And when you look at this, in terms of a historical basis, that kind of puts us back in this range, where the market broke out after, the whole, quantitative easing, post-COVID, back to normal, whatever you want to call it, market cycle. Okay, so. So with that thought there, why answering Jim's question. I see another one just kind of came through. If a put call ratio is high, is it too late? No, I don't think so, Patel. I don't think it is too late. Again, the difference between open interest and volume. Open interest is, telling us that traders are opening a lot of positions and holding on to them. And that's why I kind of like open interest. It really is telling me that if you're really bearish in the market, you're going to maintain a lot of put positions. If you're just kind of speculating, your volume is going to change from day to day, right? So watch for that. All right, so I do want to point out that in under the stock section, we have indexes. And we do have volatility indexes, which is kind of cool because, not only do we have our volatility index, the one I just showed you, but you have ones that are different dated. Again, Kevin, you could look at some of those. There's ones that are on the NASDAQ. Again, if you're trading a NASDAQ type stock, let's say a technology stock, maybe you look at the VIX of those, or here's the Dow. But there's a VIX for gold, there's a VIX for crude oil, there's a VIX for Google and Apple and Amazon. And, And again, you know, if we do that formula of what the VIX value is divided by, you know, these ones here and these ones down here divided by that 3.4, you can see that all the VIXs here and are kind of implying that the market is anticipating, you know, this big move, right? I mean, on Apple, you know, oh, excuse me, let's look at Amazon. Its VIX is almost up to 60. That's kind of implying that we're getting close to, they're looking for, you know, was that a 15% price movement, you know, over the next 30 days in Amazon? And I think if I remember Amazon, I think it's trading around, you know, $110. And if you go to an Amazon chart, I think, you know, it looks like there's support, you know, somewhere between $95 and $100. So that would make a lot of sense to me. Okay. All right. So we're getting to the top of the hour. I think I got most of the questions. If I didn't answer any of your questions, I apologize. Send your questions to support@barchart.com. We have some great guys in the support team. And a lot of them are former options traders, so they can really help you out with some of those. Where, you know, I'm more from the futures equity side, and then they'll give you a lot more detail. I'll help you out on that, especially if it's something about how to use the website. Okay. So let's talk about next week. And next week, we're going to look at our trade plan, and we're going to focus on one very particular part of our trade plan, which is setting up exit targets and giving ourselves permission to take profits, you know, a strategy of profit taking. You know, a lot of traders, I think, do a really good job on their entries, the process of finding good entries, the risk management part, but I think they do a really bad job on making sure that they put money in the bank. I mean, I'm sure a lot of you can remember a trade where you were up a lot of money and you're thinking, oh, I'm going to Hawaii, I'm going to Hawaii. And the next thing, you know, the market gaps lower on the next day on you and, you know, I'm not going to Hawaii. So you turn winners into losers. We'll look at some strategies how to do that. The other thing I want to remind you for my premium members is make sure you come by on Friday afternoons just before the close. We're going to look at the market trends for the week, and we're going to look for some trading opportunities. Also, you know, we do different segments week to week, either something that might be about the website, or recently we did where would I put $10,000 in the market. Sometimes we do something called the chart of the day, where we look at a chart that might be not a typical chart, excuse me, for you. So I encourage you to do it, and that's why I had that S&P all marked up. Excuse me. And I want to remind you that all of our sessions do end up on all of our webinar sessions do end up on our YouTube channel. And if you're watching this on the YouTube channel, please do me a favor and like our YouTube channel, and put in a comment telling me what you liked about the session and didn't like about the session, or just type in what you had for lunch. That's all I care. Anyhow. All right, Gene, did I get everything?
Yeah, I believe so, John. And well, one more thing on the archived webinars, actually, that's where today's session is showing up. I had mentioned you can download the slides from today's session. The recording's not there yet, but if you click on that, there's a link to download the slides. A couple people asked about that. Okay.
That's a great point. Let's just show that for a second, because let's see, option strategies. I'm guessing we're going to find the ones that I mentioned before. But here you can see we have an option strategy on put call ratios for those of you who are interested. Somewhere's down here. We'll find those. There we go. Bull put credit spreads. Okay, and then I guess what Gene is kind of pointing out is this is where you're going to find those downloaded slides, right, Gene?
That's correct.
Okay, great. All right, until next time, be safe out there, be healthy, and the good of all trading.